Okay, cash conversion cycle. Why is it important? It measures how efficiently a company manages cash. It's key for liquidity analysis, working capital management, and investment decisions. Liquidity analysis, the focus is, will the company have enough cash to pay its short-term liabilities, to manage its short-term liabilities? So cash, how quickly are you converting it or generating cash is very important. Working capital management focuses on the difference between your current assets and your current liabilities. How are you using your liabilities to focus on your current assets? And do you have enough current assets to meet your working capital requirements? आवाज नहीं आ रही? Okay, a second, please. सर आ रही है देखें. And finally, for investment decisions, we have to be very sure that the company we are buying or investing our money in will it have the ability to generate cash. So cash is king, and the faster you convert uh, your operations and start making money, the faster you would be in the green. Not profit, but cash. So first, let's talk about the turnover ratios. The focus of turnover ratios is to measure efficiency of asset usage. We have fixed asset turnover, we have total asset turnover, we have working capital turnover. All of these turnovers focus on how quickly is the money invested in asset converts into sales or cash. Now, three specific turnover ratios. Inventory turnover focuses on how quickly is the money invested in inventory turning into cash. So when you sell your inventory, it becomes cost of goods sold. And so this ratio focuses on your sales, cost of goods sold, to average inventory. How much inventory are you holding? So essentially, how many times in a year have you sold the current inventory holding? Receivable turnover focuses on credit sales to average receivables. Again, receivables are generate credit sales. Average receivables are the current amount you have to collect from your customers. In Pakistani financial statements, receivables will be seen from trade debts line item in the balance sheet. Payables turnover, your purchases or credit purchases, and your focus is on the current accounts payable. How many times in a year are you generating those current payables amount and then paying them off? To calculate purchases, look at ending inventory plus cost of goods sold minus the beginning inventory. Ending and beginning inventory will be given in the stock and trade accounts in the balance sheet. So the interpretation, higher the turnover, the more efficient it is. Lower the turnover indicates inefficiency and buildups. But remember, too high turnover, नेगेटिव पे की भी बात करता हूँ। अ, इनमें से तो कोई चीज नेगेटिव में आ भी नहीं सकती। इन्वेंट्री टर्नओवर, रिसीवेबल टर्नओवर and payable turnover can never be negative. Look at all the components. All of them are positive. So these turnovers will always be positive. Too high turnover or too low turnover, both indicates that a problem can exist. Very, very high turnover means that this is possible that we will run out of inventory. There will be a stock out risk. And very low turnover means that there's a chance we are not even collecting our money. Now, credit sales. How do we find credit sales in the financial statements? Credit sales are the sales made on credit, not on cash. So one method is, if it is directly given, we can look at net credit sales or revenue from credit customers. This would be in your receivable notes, trade debts notes, but mostly it is not given. So what we do is we make an assumption that credit sales are equal to the total sales. This is done because for most of the companies which are in B2B segment, most of their sales are on credit terms. So this assumption works. However, the red flag that is caused by taking this assumption that all our sales are credit sales means that we are overestimating the efficiency. Since our total sales become credit sales, our receivables turnover will become very high. Next is the days ratios. Now, once we have found the turnovers, we can convert the day turnover into days. Days in inventory DIO is 365 divided by the inventory turnover. Days in receivable is 365 divided by receivables turnover. And days in payables is 365 divided by the payables turnover. Now, days in inventory is the average number of days inventory stays in the business before being sold. So from the purchase of inventory to the sale of inventory, high days in inventory means that it's a slow moving inventory and there's a high risk of obsolescence. Obsolescence is that the thing will become useless or become scrap without being used. Low DIO is fast sales. You are converting inventory into cash quickly. You are selling of your inventory quickly. But again, there's a chance that you will have stockouts. Now, DIO is divided into three parts: raw material days, work in progress days, and finished goods days. Raw material days is the time it takes for raw materials to enter the production process. So you bought raw material from a supplier and put them in a warehouse for, let's say, 5 days before even the production started. A high raw material days indicates over purchasing and poor planning. Then are the work in progress days. The focus is how much time is spent on the production. Again, very high time indicates production inefficiencies, bottlenecks, and delays. Finally, once your finished goods is done, your work in progress days are over. Then you put it again in a warehouse before it is sold. This is the finished good days. If your finished good days is high, it indicates a poor sales planning, a poor demand forecasting. Now, total days in inventory is sum of days in raw material inventory plus days in work in progress inventory plus days in finished good inventory. Once you sum the three up, you have total days in inventory. Okay, we have made the inventory from buying the raw materials to converting and then selling them off. Now, as soon as the sales happen, we start the day sales outstanding. How many sales have we not collected for? DSO. So average number of days for which we haven't collected the cash from the customer. So sale to invoice to wait till we collect the cash. A high DSO means that we are slow in collections. Maybe we even have some bad debts. A low DSO means very good credit controls and faster cycle for days and sales outstanding. Now, if your DSO is increasing, if your DSO is higher than the industry, or your sales are increasing, but your cash is not increasing, all of these are red flags. What this indicates that we are showing that we are collecting money. But maybe there might be another problem in the company. Your DSO is much higher than the industry. Your DSO is बहुत slow आ रही है. Okay, DPO, days payable outstanding, average number of days for which the company has not paid its suppliers. Now the focus is suppliers. Uh, Over here, paying suppliers later is better than paying them early. So higher DPO is better, but only to a limit. Because if you delay paying just to increase DPO and your suppliers start backing out, not giving you good quality things, then you will start losing out on other ends. Red flags in DPO, very high DPO. That indicates cash flow stress. Your suppliers will start distrusting you and you will buy from weak or low quality suppliers. If your DPO is very low, you're not taking advantage of the payable cycle. Now we have operating cycle. Operating cycle is the sum of days in inventory plus days in sales outstanding. So essentially, our focus is how many days since we bought the inventory till we sold the inventory and then collected cash from that inventory. That is our days operating cycle. Uh, the longer the operating cycle, the longer our cash is stuck in that cycle, and the more cash we need to run our operations. Cash conversion cycle, it's operating cycle minus the days payable outstanding. So days in inventory plus days in sales outstanding minus days in payables outstanding. So considering the time from when we pay to our suppliers till the time we receive from our customers. A company with a lower cash conversion cycle quickly converts cash. It takes, it pays later to the suppliers and then earns quickly from the uh, customers. Now, the CCC could be positive, zero, or negative. Positive CCC means your cash is tied up in operations, and that's typical for most businesses. Zero cash conversion cycle, cash inflows and cash outflows, timing is same. Negative cash conversion cycle means company receive cash before paying to the suppliers. So fast, for example, it takes the semester fee from you at the start of the semester. Then over the period of time, slowly it pays its suppliers, the teachers and others. So the cash is coming in beforehand from the customers, paid at a later time. Thus, it has a negative cash conversion cycle. Cash conversion cycle is being low is good. If it is increasing over time, it is much higher than the industry, or there are sudden spikes. Then you should actually see what is the problem happening in the company. Finally, the industry comparison. Retail sector usually have negative cash conversion cycle. Manufacturing has a positive cash conversion cycle. Software as a service has a low cash conversion cycle. Education has negative cash conversion cycle. So different industries have their typical cash conversion cycles.